We live in a fantasy world now. Reality has been destroyed.
This is the time that we really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Jeff Christian, Managing Partner of the CPM Group. Jeff, thanks for joining me today. How are you?
It's always a pleasure to be with you. I'm as good as you could imagine in frigid New York City at this time in the economy and political system. Yeah.
So relatively okay, I guess we can.
Relatively, I'm very good. Yes.
Yeah. Well, Jeff, I got a lot of questions recently about what the effects of tariffs are going to be here. There's obviously going to be a big effect on not only gold and silver, not only copper, aluminum, and steel, but also America, Canada, Mexico, Colombia, many of these countries. So this is obviously going to be a very complicated and complex issue to try and explain, considering that at this point, much of it is hypothetical. At this point, much of it has yet to actually be put into effect. But where do you think we should start with a discussion on tariffs? Is it a country specific issue at this point, or a metal specific issue?
I think it's both, and we've been discussing it and working it over among our analysts for 2-3 months now, and it's a complicated issue, and it really requires like an outline of all the topics. It's an international issue, it's a country-specific issue, and it's a commodity or market or industry issue too, all at once. And you've got to deal with them all. So I think you start at the top of that outline and you say, what's the situation with tariffs? And right now, as you said, it's all hypothetical. Mr. Trump has made a big deal out of tariffs. Personally, and as a corporation, well, we're not a corporation, we're an LLC, CPM Group and I don't like tariffs. They reduce economic activity and they're inflationary. So they're recessionary and inflationary at the same time. And there's no denying that. You can look, if you go back to 1930, one of the missteps that Herbert Hoover's administration did in the early days of the Great Depression was he imposed what they called the Smoot-Hawley Act, which was really the Tariff Act of 1930. Mm-hmm. They imposed across-the-board tariffs on 20,000 items, and it was like 40% to 60%. So very stringent tariffs. Other countries obviously did this retaliatory tariffs, and you saw a 67% drop in U.S. imports and exports within the next year or two, deepening the recession, the depression. And it actually worsened the depression around the world because you're adding to the costs of everything at a bad time. And the cost to consumers. You're not necessarily adding real value to the manufacturers or producers, but you're adding costs to the consumers of goods and services. And so it's a bad thing for the overall economy, and it worsened the depression, and it gave great power to FDR to run against Hoover in 1932. So, that's a historical example. So I don't like tariffs. I don't like a lot of Trump's other policies too. And we've noticed like one of the problems in assessing all of this is he is so quixotic. He throws things out. He's even said on television in an interview in October, he said, I just throw these numbers out to scare people and get them to talk. And then we can negotiate.
Almost a negotiation tactic.
Right.
It's like, I'm going to kill your whole family. No, I'm just kidding. I'm just going to kill your wife.
Yeah. It's a very cheap negotiating tactic. I have a different way of approaching negotiations. I will say, this is what I want to charge you for this work. And this is not a negotiating ploy. This is the number that I want. And like, I've actually had clients where they said, well, there's nonsense, blah, blah, blah. And I say, okay, make it 5% more. and they say something, well, that's just rude. I say, okay, make it 10% more. And finally one of the guys stops and says, he's not kidding, I think it's a cheap tactic, and you just don't know what's going to happen. But let's assume that there are tariffs, and let's assume that they are both industry specific and country specific. So he's talked about high tariffs against Mexico, China, and Canada. He's talked about other tariffs elsewhere. Now, if I were negotiating for any of those countries, the first thing I would do is ban all exports to the United States. Just like, okay, you want to act that way, forget what you actually do. If you want to talk that way to us, talk down to us that way, forget it. Now, if you know anything about automobiles and electronics, a lot of electronic components come from China and Mexico, and a lot of electronic auto parts come from China, Canada, and Mexico. So if those countries said, when you want to apologize and come to the table in a nice way, we'll start allowing these things and 40% of your fruits and vegetables into the country again. You're going to throw the U.S. into a recession. You're going to really cause a lot of problems politically for the guy. So that's the best way to negotiate with somebody like this. When somebody is being nasty, you just say, fine. I had somebody who owed us money once, and he said, if you try to collect it, I'll sue you. So I talked to my attorneys and we sued him. And he said, why did you sue me? I said, well, you tried to sue me. I'm just going to sit there and say, oh, let me take another punch. No, So it's hard to say where the tariffs are going to go.
Well, this is exactly kind of what I was thinking about, is like, if there's no end to the tariffs, everybody can just say, well, screw it. We're not going to deal with the U.S. And all of a sudden, you're going to be in a situation where nobody wants to send you any goods.
Right.
And everybody, it just makes everybody else deal with each other and exclude you.
And you think about it like from your high school days, your college days, or your life, people say, I just don't want to deal with that person. Even if he doesn't follow through with his threats, it's like, why am I putting up with that person? At some point you say, honey, you got to leave the house. So it's hard to say where the tariffs are going to go. If they come in, the first input thing is that they will be recessionary and inflationary in the United States as well as other countries. They'll be recessionary in other countries that are exporters, but they'll be inflationary as well as recessionary in the United States. And we've been saying that we've been expecting a pretty nasty recession at some point, 2024, 2025, 2026. And we're still expecting that. And as we suss through our 10-year projections for the global economy, which we use for our precious metals and our base metals, and especially we use it across all of our commodities research in making our 10-year supply demand price projections. We have a 10-year economic outlook, and our confidence level for 2027 to 2033 to 2034 now is much higher than our confidence level for 2025, 2026, because of all of the uncertainty that he has created and that has been created by other things, changes in political leadership and tenor in Europe, in China, in Russia, in other countries. You have this increased political and economic and financial and social uncertainty, which causes economic friction, reduces economic activity. Businesses are afraid to invest in new equipment, new factories. Consumers are afraid to go out and buy high-ticket items, and that's negative for the economy. And then if you throw tariffs on top of it, it's also inflationary. So you've got a lot of issues there that could be very bad for the economy. And then on top of that, you get into the specifics. Now, as some people have said, it's highly unlikely that gold and silver would be included in tariffs. They're monetary assets or financial assets as opposed to commodities, but they could be. But you have a lot of base metals. And if you go back to the first Trump administration, he imposed tariffs on aluminum and steel from Canada and from a number of other countries. And then the Canada imposed retaliatory tariffs on steel and aluminum products because they were coming back. There's a two-way flow for all of these things, pretty much, back and forth. So, and that lasted for, I don't know how many months or quarters, and then they got rid of it, and then Trump did it again. So there's this very quixotic, fluid uncertainty there that's going to be there. But, the tariffs will definitely be more destructive for base metals and specialty metals and steel. And they would be very inflationary and problematic for U.S. manufacturers and consumers. So that's where it is. Now, you put that all together and you say, as I said just a minute ago, gold and silver probably would be excluded. Even if they're not excluded, you put all that together and you say, this increases the risks and uncertainties that consumers and businesses and governments face. And when they're facing increased risks and uncertainty, they tend to buy gold and silver. So tariffs could be good for gold and silver prices. They could make it more difficult for American citizens, U.S. citizens to buy. Probably not, because there is, in fact, a lot of gold and silver out there. But it's probably that it would probably be good for gold and silver prices because they would worsen a recession, increase inflation, decrease overall activity economically, decrease world cooperation, increase global tensions, all of which are uncertainties that tend to cause investors to say, I think maybe I should have more of my wealth in gold and silver. Mm-hmm. So the short answer is they're probably good for gold and silver if they happen.
Mm-hmm. Again, this is a discussion that I've kind of touched on a little bit, but, wanted to really base a lot of our discussion today around, I want to understand if, you're saying gold and silver would probably be exempt. If he slaps let's say a 10% across the board tariff on Mexico, mm-hmm. would that not include metal that comes out of Mexico, including silver, or would it specifically state we will not be charging this tariff on gold and silver, but everything else that comes out of Mexico, we will?
We have no idea right now, and that's a problem. And you can look at other things that he's done in the first week of his presidency, and you can see the same sort of problem. So earlier this week, the White House issued this executive order that they were going to halt all payments to organizations. And that immediately everybody said, well, this is very problematic. It's problematic for people in Medicare, Medicaid, Social Security, food stamps, schools, governments, federal, state governments get a lot of money. And the initial executive order said everything, blanket, which is what he's talking about with tariffs. As soon as they issued that and it became public, they started backtracking. No, Medicare, Medicaid, Social Security, those are excluded. Oh yeah, state payments to the states for education, that's excluded. Oh yeah, food stamps for poor children, that's excluded. Oh, money to the schools for food for students, that's excluded. And so you start seeing that. So right now he's doing this. Well, I'm going to put 20% tariff on everything from everybody. And then he'll immediately have to backtrack. Mm-hmm. And it goes back to what I said about the way to deal with temper tantrums. You shut down the auto industry, you shut down the steel mills, you shut down the aluminum foundries, you shut down people who make aluminum siding and gutters, you shut down electronics because you've got these obscene tariffs. It's going to, they'll immediately be backtracking.
Mm-hmm. So let's just take a hypothetical example and work with that.
That's what I did.
Yeah. So let's say he takes and puts a 10% tariff on anything coming from Canada. Mm-hmm. Let's just work with that example. So how does that tariff work? For those that don't understand, does that mean that basically they need to collect 10% above and beyond that product to go to the US government?
Yeah.
Or the value of that product?
And just to put it in context, I think there's about $50 billion of metals and minerals that come into the United States from Canada every year. Okay. I think that's about what the number is. I won't, don't hold me to it. Mm-hmm. What happens is the Canadian company, the producer, mm-hmm. sells it to a U.S. company that wants to import it. That U.S. company has to declare it at customs mm-hmm. and pay the tariff. So the Canadian company pays nothing mm-hmm. in terms of a tariff. The existence of those tariffs may reduce the demand for that commodity and drive the price down. So the Canadian producer may not get as high a price as it otherwise would. Mm-hmm. But the tariffs are paid by the importer. The importers then pass that tariff on to the manufacturers that they're supplying, mm-hmm. who pass it on to the wholesalers, the retailers, and the consumers. Mm-hmm. And that's why it's inflationary, because mm-hmm. what you're doing is you're not necessarily changing the price or the cost of a good, but you are adding fees to it that accrue to the U.S. government as mm-hmm. opposed to the producers or any of those processors and manufacturers, and get paid ultimately by the ultimate consumer. Yeah. So that's the mechanics of it. You know, mm-hmm. no exporter pays that tariff. It's mm-hmm. the importers that pay it, and they pass it on. And if you don't believe they pass it on, you're very naive.
So saying when he says we're going to slap a 10% tariff on Canada, it's almost like saying we're going to slap a 10% price hike across the board on all of the stuff coming into this country.
Correct.
That's how you should almost hear this, right?
That's exactly how you should see it. Mm-hmm. Yeah. And the end consumer might not be able to say, oh, wow, this is 10% more expensive. Mm-hmm. Because again, you look at it, it's raw materials, it's metals, it's minerals, it's sulfur, it's componentry, electronic components, auto parts. And so, that auto part might not be a significant cost of the car, mm-hmm. but a bunch of auto parts coming from Mexico and China and Canada add up, and the cost of that car goes higher. Mm-hmm.
So let's go back to let's say the supplier side or the demand side of that mm-hmm. equation.
Right.
If let's say that forces the US manufacturer, again, hypothetically, to go out of business, and that drops demand coming into the US, that ends up being basically recessionary for the rest of the world in some ways, right?
Yes. It's recessionary for the US because it raises the cost. Mm-hmm. So everybody buys less stuff because they have less money, the money spread to those things. But it's also recessionary for the world. Mm-hmm. And it's recessionary for the countries where those products are produced that face the tariffs. Mm-hmm. So if it's a 10%, tariff across everything coming out of Canada, it would be a real hit to the Canadian economy for as long as those tariffs remained in place.
So does this not force these suppliers in tariffed countries to find demand elsewhere?
Yes, absolutely. Mm-hmm. Yeah.
This forces the cooperation of the rest of the world and demand, just like we've seen with, let's say, Russian oil, for example, since the beginning of the Ukraine war. Right.
Yeah. I mean, there was a shift in Saudi and Russian oil destinations before the war. The war has accelerated it, but it's exactly that, so everybody gets together and they don't invite the United States to a meeting where they say, okay, I've got excess vanadium. You need it? Fine. I'm going to get lower price than I would have if there weren't U.S. tariffs on vanadium imports, but that's okay. At least I'm selling my product.
Mhm. I think, no matter what, this ends up being, as you said, inflationary and recessionary if these extra costs, these further complications are added to this. And the reason I say that is because I can imagine a scenario as well where Canada is the one that's tariffed. So they end up sending their metal, let's say, to, just
China.
Conceptually, let's say China, Germany, whatever. And then because I think China is the wrong example because they're, likely going to be tariffed as well. But let's say it's country X that is best buddies with Trump and they don't have any tariffs. So Canada can sell to that country.
Yeah.
Maybe they can refine it or, use it as feedstock for their raw product and then sell that to the US. However, you still have to account for that increased cost of, at very least, logistics and transportation to country X in order to get it into the US. Is that right?
That's basically it. So yeah, you're creating friction in international trade, and that friction costs money. But there are different ways that tariffs can work. You can say, I'm going to put a tariff on imports directly from Canada, or you could say, I'm going to put a tariff on things made in Canada that are transshipped through Hungary, where I like the president. So, so all of a sudden, and you'll see, well, I'll get to that in a second. Or you can say, I'm going to go a step further and say, if a manufacturer in Hungary uses, vanadium from Canada in a manufactured product, even if the vanadium content is a low portion of the value of that final product, I'm still going to impose a tariff on it. Yeah. So, one of the things that we've seen over the last 3 years is a tremendous amount of goods going into Uzbekistan, Kazakhstan, and Turkey. And they've actually had, all three countries last year were selling gold because they needed foreign exchange. They needed dollars to pay for imports. Well, it was two things. Now the goods going into those three countries were being transshipped to Russia, right? At premium prices for the people who were busting the sanctions. They made a lot of money busting the sanctions, taking the risks of having sanctions imposed on them, et cetera, et cetera, et cetera. So they needed increased foreign exchange to buy all those goods they were transshipping. In addition to which, there were a lot of people who were making a lot of money off of those transshipments, and they were buying more stuff for themselves. So those three countries were doing those transshipments, and they ran out of foreign exchange, or they ran low on foreign exchange, had to sell some gold from their monetary reserves to raise dollars to pay for that commerce. So yeah, there are all kinds of things, but part of it is, how are the tariffs worded? Is it a tariff on directly shipped materials, or does it include transshipped materials? Because you have these interesting things, and like if we switch from Canada to Mexico, you have copper concentrates and you have lead and zinc concentrates that have tremendous amount of silver content, and you have silver concentrates that have a lot of copper, lead, and zinc in there. You put those tariffs on, and you say, okay, but I'm going to exclude gold and silver because we need the silver. And we need, and gold's a financial asset. So, we'll exclude gold and silver, but these are concentrates and they have copper, lead, and zinc. So we're going to impose a tariff on the portion of the value of those concentrates that are base metals.
This is getting complicated.
It gets complicated.
And adding friction.
And then, well, how do you know what the value is? Oh, well, the exporters or the importers tell us. I mean, if you look at U.S. trade statistics, I don't know if it's still this way because I've stopped doing this, but there used to be quotas on pasta from Italy, and the pasta manufacturers would hit their quotas limits, so they would say, "Oh, this isn't pasta, this is rigatoni," and the U.S. Trade Board would say, "Okay," and they would have a subfile for rigatoni. And then they would hit the limit there and they go, oh, it's spaghettini. You would do
No
this.
wonder they've come up with so many different pastas.
If you look at the U.S. trade data, and this goes back to the 80s and 90s when I was involved in paying attention to imports and exports of metals and commodities and stuff, there were the enormous number of categories of pasta. It's just like that weird. There were all kinds of clothing that came from Switzerland that was actually manufactured in Turkey and other countries. They hit their quotas of how much clothing they could import into the United States. So they would send it to Switzerland, where there were companies that called themselves relabelers. And they would put a label made in Switzerland into the sweater and then ship it to the United States. So there are all kinds of weird things that go on. And what you're doing is you're distorting trade, and you're limiting trade, and you're adding to the cost of that trade because you're transshipping it. And, it's all friction on the global economy.
So, Jeff, again, if we think about this theoretically, and if everybody says, screw you guys, we don't want to be part of this added friction system.
Right.
Would that not stand to reason that at some point the U.S. starts having to rely heavily on its domestic, let's say, stores of vanadium, as you said, and at some point have to kind of loosen restrictions and really kind of fast track the ability for mines to get built to be able to extract those resources or metals that are needed, like, for example, a vanadium project in Nevada that needs permitting and building?
Yeah. In a long-term basis, that's true. The problem is, how long does it take to identify, prove up the reserves and resources, get it permitted, and you have to understand that you're talking now about local and state governments as well as the federal government. And, the White House doesn't have as much control over what state and local governments do. And then you have NGOs and you have local people coming in. So, the average deposit might take 20, 25 years now to develop. In the meantime, you're not going to be making high strength, high tensile strength steel that has vanadium in it. You can substitute tungsten. Okay. I think we closed our last tungsten mine after World War II. So it's going to take some time to rehabilitate that baby. So you've got real problems. It's a lot easier and cheaper and faster to deal with getting over the tariffs and getting rid of them and coming to some sort of economic sense than it is to develop a mine that's been shuttered for 80 years.
Seems like it's a lot better of a solution to just let the free market do what it needs to do.
Exactly. Yeah.
So is there also a possibility, again, let's take this 10% Canadian or 10% Mexican hypothetical scenario, that the country that has this tariff imposed on it starts to devalue their currency by that same amount? Is that a strategy to retain that trade in some ways?
Well, there's no value in them doing that because, again, they're not paying the tariffs, right? So they would be sort of shooting themselves in the foot and saying, does that hurt? So it wouldn't happen. Now, their currency might devalue in the free market because they've lost market. So all of a sudden, it's like, here's a country and X% of its GDP exports, and Y% of that is exports to the United States. And that's now under these tariffs. And so we're seeing a contraction in exports to the United States, and that reduces the economic activity in that country. And ergo, that country's currency deteriorates. And there's this nasty thing about it. I was talking about it earlier. When all of these bad economic conditions and political tensions rise, investors buy, I said, gold and silver, and that's true. But they also buy U.S. dollars and treasuries. It's, so, hey, I'm the U.S. government. I'm going to cause economic pain and problems for everybody. And the result's going to be people buying my treasury bonds. Yeah. So, hey, okay, you're underwriting my misfeasance, financial misfeasance, yeah, because I'm causing you economic pain.
Which actually works against Trump's stated goals, which he needs a lower dollar for, right?
Right. I mean, we've been working for 3 months now on what's our economic outlook. And as I said, we have a greater degree of confidence in our longer term economic outlook, which is negative, I should say, for the world. But 25, 26 is a real problem. And it's a real problem because if you look at a lot of the things, not just the tariffs, but other things that he's talking about, you're probably going to see a more severe recession than we would have seen otherwise. You're probably going to see higher inflation, and you're going to see larger deficits, fiscal deficits, and higher, faster increase in federal debt. So all negatives as a consequence of his policies. Yeah.
So, Jeff, what is CPM's outlook for recession here within the U.S. and maybe we can expand that to the broader world for the next, let's say, as this morning, 24 months.
Yeah, we're talking on the 30th of January. This morning, the BEA, Bureau of Economic Analysis, came out with its GDP flash, the first estimate for fourth quarter and full year. And it was about 2.2, 2.3 for the full year GDP, which is better than a lot of people thought. Our expectation is that you might see GDP and economic activity goosed initially by increased government spending. And then it rolls over into a recession because, the Fed, instead of lowering interest rates the way Mr. Trump wants, has to raise interest rates because of stronger economic conditions and possibly increased inflationary pressures if he does go ahead with tariffs, right? So you could have a situation where he imposes tariffs, he does a variety of other things that cause increased demand for goods and services, higher inflation. Fed has to raise interest rates even as the deficit is expanding. And then we go over into a recession. We're looking at a recession possibly in the second half of this year into 2026. And we're looking at a relatively deeper recession compared to what we saw in 2010 and 2020, 2001, 2000, and 1991. We saw very short and shallow recessions in 91 and 2001. We saw a bigger recession 2007 to 2009. And we think that it could be almost as bad as that one.
So how does that also, let's say, extend to the world, really? If the US is going through a recession, is it possible that the rest of the world suffers as well?
It's very possible. I mean, you've already seen, like last year, there were a couple quarters where Germany, I think, and a couple other countries in Europe saw negative economic activity, economic contractions. Yeah, if you're talking about negative growth, it's an economic contraction. It's less economic activity. Our view is that you see a recession in industrialized nations. You see a sharp decline in emerging nations like India and China and Vietnam and Indonesia, but not necessarily going into an actual contraction, but much slower growth because most of those countries still are heavily dependent on exports. And then you get a recovery at some point. But from our view, when we see an economic recovery, 2027 or whenever, our expectation is that it will be more anemic than previous recoveries because a lot of these problems are not going to go away. They may ebb and flow, but they're not going to be resolved.
Because of the possible papering over and money printing that is going to result at or going to be a result of this this recession once we get into it?
That's the vaccine. But yeah, I mean, they're not going to be resolved because the powers that be in most countries do not see it in their political and economic best interest to resolve these things. Mm-hmm. So they will persist and they'll try to paper over the problems in order to get us out of a recession and not let that recession devolve into a depression. I mean, that's why they printed so much money, not only in the United States, but around the world in 2007 to 2011. It was, the powers that be in all of these countries said, if we don't manage this and get us out of here, it's not the end of our political career. It's our heads on spikes. So we've got to do whatever it takes to resolve this recession and restore some economic activity. So yeah, and the way they do that is they paper over,
which very likely eventually ends up being highly inflationary again, right?
Absolutely.
Mm-hmm. Mm-hmm. Amazing how this cycle just keeps repeating itself. And this, as you said, this political will and capital to not take the pain is, directly correlated to this.
I'll date myself. Back in the late 60s, early 70s, the Commerce Department in the United States had this monthly report of statistics. This was before the internet, so you had to get printed out reports. Mm-hmm. And it was called Business Cycle Digest. And in the late 60s, the
sounds riveting. Huh? It sounds riveting. My wife used to be appalled when I'd bring it home to read on a weekend. But the economists at the Commerce Department in the late 60s said, we have banished the economic cycle. There'll be no more recessions and inflation. So they changed the name to the Business Condition Digest. And so they could keep the initials. And it was like, no sooner did they do that than we fell into a deep recession, and the business cycles are still there. And, it's sort of, I was a science geek in grade school and probably still am, but there was a volcano in Iceland in the 60s, and the lava was flowing toward a village. So Icelandic government got all these firemen with these heavy duty hoses to spray the lava and cool it and create a dam of cooling lava to protect the village. And it was this great success. And then the lava kept flowing and it went around the dam and destroyed the village. That's what governments do. They put together a Band-Aid to keep things going until they're voted out of office. Jeff, it's been postulated that Trump would like to, let's say, abolish the federal income tax and fund the government through some type of consumption tax and tariff. Do you think that is a possible scenario to get to?
It's possible to get to. I mean, to be honest, the Republican Party has been pushing to get rid of or reduce the federal income tax and replace it with a value-added tax since the 1980s. And since the 1980s, we've had basically back and forth divided governments. And we also back then perhaps had more ethical Congress people than we do now. So one of the, there's a great deal of fear among rational economists right now because we have a unified government. And we have a unified government that's populated by really clearly unethical people. And clearly people who don't quite understand economics 101. So there's a real fear that things like a value-added tax, which would be incredibly regressive and recessionary, could actually be pushed forward over the next 2 years. It would be regressionary and regressive, and it would be recessionary. But they've been asking for it and pushing for it for about 40 years.
But, maybe the short-term pain could be worth the long-term gain. Is that a possibility?
I don't know. I don't see that in the case of a value-added tax, because I don't see what the short-term gain would be unless the value-added tax was so high that it could allow for a lower deficit. But the deficits have gotten so enormous, you couldn't do that. I mean, if you look at some of the European countries that had, 14, 18, 20% value-added taxes, their economic growth has been subpar compared to the United States and other countries for decades.
Just doesn't let them compete.
Which is why they're Europe. It's why people like the dollar over the euro. I mean, if you look at central bank foreign currency holdings in the US dollar have maybe fallen 2 or 3% over the last 30 years. But over the last 20 years, euro holdings have fallen from 29% to 19%. A third of those holdings are gone. And the reason is that people look at the relative economic performance of the United States, the relative security of having U.S. Treasury bills as opposed to EU euro bonds issued by a European country.
At a negative interest rate, nonetheless.
Yeah. People will accept a lower interest rate from the United States because of the increased risk. And if you look at Treasury holdings, overseas Treasury holdings, they were up 15% last year. They're at record levels. There's more money held in U.S. Treasuries overseas than ever before. It went from like $8 trillion at the beginning of last year to 15% more. Now, a portion of that is held by U.S. pension funds, companies, and wealthy individuals who want to hold money offshore, but they don't like the currency risk. And if they hold their treasuries offshore, they're denominating their foreign holdings in dollars. So they don't have the currency risk.
Right.
But they can also avoid some taxes.
Jeff, as we're talking about the deficits and funding the government going forward, one of the ideas that has been put forth is this idea of a gold-backed bond, a long-dated gold-backed bond. Do you think that that's a reasonable idea or step to make towards, funding the government to be able to make some changes at this point?
I don't think it's a reasonable thing. First off, I don't think there's not enough gold to back it, and several things would happen. First off, I'll tell you an anecdote, but there's not enough gold to back it. And the thing is,
at this price.
Yeah, you'd have to get to the U.S. has more gold than anybody else, 261 million ounces. That gold at $2,000 or $3,000 represents less than 1/4 of a year's deficit. So forget paying down the debt. You can't, and we've seen this where gold bugs have said, "Oh, we're going to have to go to a gold-backed bond." And there's been all this stuff about the BRICS going to a gold-backed currency, which the BRICS say, we're not doing that. Putin says, I'm thinking about this, or what he says actually, because he chooses words very carefully, the Kremlin is thinking about this.
Right.
The Central Bank of Russia says, we're not. It won't work.
Yeah.
China, India, Brazil, South Africa, they say, we're not interested in a gold-backed currency. If you have a gold-backed currency, the first thing that happens is people say, here's my currency, give me your gold. So then the gold bugs who are promoting this myth say, well, it doesn't have to be gold convertible, it can be gold backed. And that's like an open marriage. It's just nonsense. A gold backed currency that is not convertible is not gold backed. It's just not there. And 92% of the open marriages get divorced within a couple of years. So, it doesn't make sense. I tell you two anecdotes. One is, many decades ago, I was talking to some central bankers and they obviously talked to me about gold. And I said, so what are you guys' thoughts about a gold standard, a gold-backed international currency regime? because we've been talking about an international, what replaces the dollar since the 1970s. That conversation has occurred among central bankers. What will replace the dollar and when, and how? And it's always been known that it's decades long. And 50 years later, I started looking into it in 1975. So it's been 50 years that I've been looking at it. And 50 years on, we're still looking at it and saying what's going to happen. So I said, what's the bank's thoughts of a gold-backed standard international currency regime? They say, when we think about a gold being used in the currency system, we ask ourselves two questions. How long would it last before it collapsed? And how much damage would it do to the global economy? Right? So that conversation occurred in the 90s. Now, 2019, 2018, I had a Chinese client that paid me to arrange for an interview with Alan Greenspan. They knew that I knew him since 1981, and that he had respect for me, and I had respect for him. And so the Chinese client paid him, and he paid CPM, and we did this interview. And after that, we were having lunch. And I said, you've always talked about the wisdom of a gold standard. But if you look at the economic activity during past gold standards, in the 1870s, 1880s, 1890s, the U.S. had a gold standard. And we saw 3 depressions over 30 years. We saw 3 periods of hyperinflation punctuating those depressions. And, how can you say that the financial system would be more stable under a gold standard? And he said, well, of course we had that because we were on a gold standard. That's what happens under gold standards. You have depressions and you have periods of hyperinflation because the supply of gold can never keep the same pace of growth and expansion that's needed for the economy. And if you think about it, we haven't had a recession since 1930. In the 5 years from 1907 to 1913, when we created the Fed was created in December of 1913 and built out over 1914. In that 5-year period from 1907 to 1913, the U.S. economy was in a recession 60 of the 90 months, or 60 of the 90 quarters, whatever the math is, quarters. Okay. So a gold standard would be extremely destructive of economic value. And most central bankers know that. They still want to own gold, but they see it as a valuable monetary reserve, but not necessarily as something that should be the denominator for a currency system.
Did you say that we haven't had a recession since the introduction of the Fed?
Depression.
Okay. You said recession. I wanted to make sure that we get that clear.
Yeah, we had a depression in the 30s, 1929 to 1941. We had a depression, but we didn't have 3 depressions over 30 years.
Gotcha.
The way we did under a gold standard. And I'll tell you another anecdote. In the 80s, I showed that chart of U.S. GDP to Ron Paul. And I said, you keep saying that the Fed has created economic volatility, but let's take a look at this. And he walked out of the room. And there have been several times since then when we had the opportunity to have a conversation, and he just cuts it off. He will not talk about it because the reality is that the Fed, having a national central bank, having a well-run national central bank, leads to less economic volatility. Now, central banks are human events. From 1950 to 1971, we had William McChesney Martin as the Federal Reserve Board chairman, and we had a Fed that was dealing with all of the economic problems of the post-war period and a fixed gold exchange rate. And he did a really good job. He retired in 71, and from 71 to 79, we had some really spotty Fed chairman. And we had periods of 14% inflation, and we had periods of we had recessions every 4 to 6 years. Volcker came in 79, and since 79, we've had recessions maybe every 10 years. Mm-hmm. And they've been shorter and shallower than the recessions that occurred prior to the Depression. Yeah.
But the argument is always brought forward after that those problems aren't solved. They've just been kicked down the road and eventually create a larger problem down the road. Is that not a reasonable line of argument?
You solve some problems, like the Icelandic fireman. You solve some problems, but you no system's perfect. Mm-hmm. The only currency system that's ever has not failed is the current one. You've got these gold bugs who will talk about the 5,000 currency systems that existed throughout history, and they were all backed by gold except the current one. They are all gone. Mm-hmm. They've all failed over time. So none of these systems are perfect, and none of them preserve buying power for currencies or for gold over time. So the key is to find something else that's there. Now, you could take a libertarian approach and say, listen, under a gold standard or other fixed currency exchange rate systems, the governments set the currency exchange rates. And every so often, those currency exchange rates are out of whack with economic realities, and you have to devalue and revalue currencies. In 1971, we went to a floating exchange rate. First, it was called a dirty float, and then we got to a clean float, where government said, you know what? We have currency markets, and they're getting bigger and bigger. And the currency exchange rates are decided minute to minute by the market and market participants, individuals. It's a free market. And it's not the government saying, hey, this is what these currency exchange rates should be. Yeah.
So, Jeff, what are let's say, the commonalities between these countries that have been buying, and I don't know if hoarding is the right way, but buying gold hand over fist over the last 2 or 3 years here?
First off, there are about 20 central banks that have been buying gold. 20 last year, 20 in 2023, maybe 22 in 2022. So it's about a fifth of the central banks, or fewer than a fifth. No, it's actually, I guess, closer to a tenth of the central banks, because I think there are more than 180 central banks. Mm-hmm. The commonality has shifted since 2022, but from 2005 to 2022, the commonality were that these were countries that they were not major trading countries prior to 1971, when the dollar gold Bretton Woods exchange rate was there. In the 1950s into 1960s, you saw central banks getting a surfeit of dollars. America was 40% of the world economy. We were buying stuff everywhere, and we were paying for it with dollars. We'd buy a car in Germany, and we'd pay for it in dollars. The car manufacturer would go to the bank and exchange those for Deutschmarks. The bank would send those dollars to the Bundesbank. The Bundesbank would come to the Treasury and say, if you think that the dollar is $35 an ounce, here are my dollars, give me your gold. Mm-hmm. And you saw central banks that were active trading entities, nations, building gold reserves. After that, you went through a period in the 70s where it was kind of low. And then you had some of those central banks had 80, 90, 95, 97% of their foreign exchange, of their monetary reserves in gold. So they started selling gold, and you had this period of time from, say, the 1980s into 2005, where those central banks were selling some of their gold. Like Britain and Switzerland said, we want to sell half of our gold. Australia and Canada said, we want to sell most of our gold. Other countries, meanwhile, entered the economic world. China, India, Soviet Union / Russia, Eastern European, Asian countries, all became like the Asian tigers. They all became big exporters, and they were paid for their goods and services in US dollars. And they had 80, 90, 95% of their monetary reserves in US dollars. And they said, I think I'd like to have like maybe 60% of my foreign exchange reserves in US dollars and maybe elsewhere. So let me start drawing down my dollars, building up my other foreign currency reserves, and buying some gold. So the commonality for central banks prior to 2022, 2023 was these were countries that were not active trading partners prior to 71 and had not built up gold reserves. They had built up dollar reserves after 1971, and they were diversifying their portfolio. Since 2022, with the Russian invasion of Ukraine, you've seen two cycles. One was countries like Ukraine and Kazakhstan and Turkey buying gold. And then this year, or 2024, you saw Poland and Serbia and some other Eastern European countries that border Russia buying gold and having it stored in the New York Fed. Yeah. So you had seen a lot of gold move out of the Fed in the 80s and 90s for reasons I can explain that I don't need to. You started to see last year or late 2023, you started to see central banks in Eastern Europe saying, I want to have more of my wealth in gold and I want it stored as far away from Russia as possible.
What kinds of things, because obviously you have clients from all over the world, Jeff, what kinds of things are your clients most worried about right now or trying to get most clarity on right now?
Everything we've talked about. Yeah. I mean, the biggest lack of clarity right now is the economic and political landscape. And what does a Trump administration, what will they actually try to do? What will they succeed in doing? And what will be the reactions to those actions? In addition to that, there's concern about a breakdown in international cooperation. And there is a concern about the need to reform international organizations. If you look at the BRICS communique last October, they had their big summit in Russia. And the BRICS communique said, we would like to see a more balanced international financial system centered on the IMF. The gold bugs were saying, oh, they're fighting the IMF. They're going to come out with a gold-backed BRICS currency, et cetera, et cetera. And in the BRICS final communique, they said, no, we want to see the international system work on a more balanced, fairer way. And that's actually a demand that they've had since the 1950s. The non-alignment movement started in the late 1950s. It still exists in theory. It has like 180 countries or so that are members, but it's relatively ineffective. But these various governments have been saying, we'd like to see a more just balance in political, economic, and currency systems. But there's the biggest thing that we're being asked about is the economic and political uncertainties and the breakdown of cooperation and what that means for gold and silver. There is, obviously concern about supplies of gold and silver. There's been a tremendous increase in the regulatory and permitting issues that have caused the average time to build a mine to go from 5 years to 10 years to 20 plus years. And what does that mean for that supply? There's a lot of concern about money laundering and unregulated and illicit money flows because there's so much money floating around the world right now. And we try to work with legitimate, honest companies and investors, and they get caught up. Like, we have to make sure that we're not being touched by groups that are illegitimate or illegal activities because we don't want that spillover. The same way that the People's Bank of China has limited the activity it does with the Central Bank of Russia, because it doesn't want somebody to come along and say, oh, you're breaking these sanctions.
One of the other things I've been hearing a lot about is this rising premium for exchange for physical program, and that the LBMA is basically has to go to the central bank, is a story that I just saw, go to the central bank to borrow gold. Are the LBMA and these let's say storehouses for gold and silver, are they running out of metals? Or what explains the EFP premiums and these borrowing premiums, these gold ETF short premiums all rising at this time?
Yeah. First off, you have to understand the LBMA is a industry trade association. So they don't do any of this. It's individual banks and trading companies and dealers that actually are doing the trading. And you've had a situation over the last few months. Initially, it was there's a lot of demand for gold and silver in the United States, for fabrication demand, for investment demand. Investment demand on a global basis for physical gold rose about 30% last year, 35%. And a lot of that gold was being stored in the United States. In addition to that, you had the central bank gold from Poland and other countries. They were not moving their gold. They were buying gold in London and having it shipped to New York. So there was a real increase in demand in the United States, and to a lesser extent Canada, for precious metals. And that metal was being drawn out of depositories within the outer belt of London, that are depositories that are registered with the LBMA and participate in that process. And one of those depositories, in fact, the biggest one in terms of volume of gold, was the Bank of England. The Fed in New York will not have a deposit from a non-government. The Fed, you have to be a government to have your gold at the Fed. The Bank of England will allow private banks and others to have deposits there. And that's why you saw a lot of gold move out of New York into London in the 80s and 90s, because those central banks were selling their gold, had to be upgraded to good delivery, and then they moved it to London where they could hold it. So it's a big London local market. And what you're seeing started as a shift in the physical demand to greater demand in New York than in London. That started it. Then on top of that, you saw speculators come in and say, hey, look at what's going on. Then Trump started talking about tariffs. And somebody said, ooh, if you're talking about a blanket tariff on gold and silver, or a blanket tariff on Mexico and Canada, you're talking about a lot of silver and a lot of gold. And he's talking about a tariff that might include silver by origin as opposed to where it's coming from. So if you have Mexican silver or Canadian gold in New York, in London, and you try to ship it in, you're going to get hit with tariffs. So a few banks started moving some gold and silver out of London into the United States. And they were doing that, A, because of the greater demand. There was an arbitrage opportunity because of the greater demand in New York. And B, in concern that there could be tariffs that would limit or add to the costs there and make that middle argument. Then the speculators saw that and they poured in. So there's been this tremendous amount of speculation over tariffs and over that. And as a result, a tremendous amount of gold, I think about 10, 20 million ounces, maybe 30 million ounces, has moved from London to New York. And you've seen silver move from London to New York. There is still, I can't remember the number. I have it right here, but I won't stop to look for it. There's still quite a bit of gold in the London market. A lot of it is tied up with ETFs and other financial bonds and notes that hypothecate it. So it's allocated in essence, but about a third of it is still unallocated. The problem that we're seeing this week is the Bank of England is like the Fed. Its vaults are very old. except for the new ones that they built that no one's supposed to know about. They're not designed for large amounts of metal moving in and out. So it takes a long time. Yeah, we had a central bank client that came to New York in October, and we initially said we're going to set you up to see the gold vaults below the Fed. And the Fed called like the week before, and they said we can't do that because we're moving a lot of gold in, probably Poland. They would not verify that, but Poland was buying gold, and there was a lot of gold moving into the New York Fed. And they said, and the passageways are very small. We can't have visitors when we've got a lot of gold stacked up in the passageway waiting for the bar lists to be checked. And that's what's going on at the Bank of England right now. It's just a process of getting the stuff out the door, literally. Now, understand this. There are hundreds of millions of ounces of gold in Switzerland. Yeah. So the idea that Europe or London is running out of gold, London may have seen a drain on its supplies, but there's an agreement between Switzerland and the UK about basically sharing their metal access. So there are hundreds of millions of ounces of gold that go unreported in the UK, but outside of that outer belt, that is the border for the LBMA depositories, and in Switzerland and in Germany and in other countries. So there's a lot of gold over there still, and a lot of it's available to the market, either for purchase or for lease or for swaps. So it's really pretty much a temporary thing.
Just because of the logistical constraints of getting it in and out.
Yeah. There's something I want to say at the very end, but it's compounded by a speculative buying. But the thing that these guys, speculators and pontificators, don't seem to realize is arbitrages go both ways. And if London runs so low on gold that it's an issue, the arbitrage will reverse and all that metal goes back to London.
Right.
And the shippers and the airlines are the guys who made the money. Yeah. Arbitrages go both ways. And people seem to forget that because they think only in cataclysmic terms.
Yeah. The shippers make money on both sides, moving it back and forth just to capture that premium.
So do the brokers. Yeah.
Wild. But, at the end of the day, again, it's not like you're bearish on gold or silver. You don't hate it. It's just discussing the reality of the situation that we're facing, right?
Right. Yeah. I mean, look, personally, I'm long gold and silver, but I've been long gold and silver all my life, ever since I got out of college and had money to buy some. Yeah.
Well, I think you guys issued your last buy recommendation at something like $1,600 and have not revoked it, right?
From a longer term view, yes, we issued a buy recommendation, I think in 2013 or 2014, and that's still in place from a long term view. We have shorter term views, and I think in the middle of November, we said stand aside because of the volatility. And then in the middle of January, like the 16th of January, we issued what we call ultra short term trade recommendation, which said, the gold price was like, I don't know, 25 something, I guess. We thought it could go to 2,800. So today we issued a ultra short term gold trade recommendation that said, take your profits. If you're an ultra short term trader, take your profits and stand aside. If you're really bold, you might go short with the expectation that next week the gold price could fall $20 or $40. But then be prepared to reestablish your long position if the gold price falls back below 2,800, which it just rose above today.
For futures.
Once the COMEX February roll is behind us, which is possibly as early as tomorrow, and once that ARB comes back in, the gold price could come off on a very short-term basis. Longer term, all of these things we've been talking about, these economic and political issues, to tell us that our investors should be long gold and silver. Yeah, it's just the state of the world is such that you really want to have some precious metals in your pocket.
Well, Jeff, I think that's a good place to kind of wrap up for today. Is there anything else that you'd like people to keep in mind before we do?
I think we've covered the waterfront. I think we've done a good job.
The current waterfront. Yeah, absolutely. So for those...
the waters will rise and someday my house will be beachfront property.
Okay, Jeff. For those that want to read more from Jeff and CPM Group as a whole, you guys do excellent research. I've personally read through the silver yearbook, the gold yearbook myself. Lots of interesting stuff. All kinds of other products there as well. That's all available. cpmgroup.com. And of course, on Twitter at CPM Group LLC. And of course, you do, is it a bi-weekly YouTube
Bi-weekly,
video?
twice a week we do videos.
On your YouTube channel at
our YouTube
CPM
channel.
Group.
Yeah.
Perfect. Jeff, thanks so much for your time today. Always a pleasure.
Well, thanks for having me back and best of luck for the year.
Thank you.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.